Welcome to video 5, trading strategies. Like I said, we would come back to the platform many times, and there we are back. At this very moment I am live, and you can see that with the change. You can see we're trading Apple, and you see that it's going up 73 cents at this very moment. You see the bid, you see the ask price, you see the volume. You see the IV rank, which went from 28 to 26, and you see all this. What you don't see was that bit which I showed you before, and that was the day chart. As you can see, you can actually put that away. Boom. You can also put this all away. Boom. But you can also take it up. Now there are many strategies you can use in option trading, and I will only discuss two of them in this book. The two are called credit spreads and iron condors. The reason that I do that I want to have the basics first before we can trade any other strategies in the future. When you go to the live trading sessions, in the beginning I will only trade credit spreads and iron condors, but later on I will gradually teach you more and more strategies. When you buy or sell an option, you go to the bid and the ask price. Now the bid is selling the contract and the ask is buying the contract. There's a difference between the bid and the ask, so I will open this up. Let's go to September the 20th, and there you can see the bid and the ask. There's a difference, and you can see actually in the book it's 2 cents, but here it is suddenly 5 cents because we are now at a live trading platform. So here it is different. In the picture, when I took the picture, it was only 2 cents. The bid and ask. The ask is buying, and that is always more expensive than selling. Now the difference between the bid and the ask is important, because the bigger difference there is, the less liquid an option is. So you can also see that here you've got 210, 212.50, so there's 250 difference. If there is a lot of difference between the 335 and the 345, which is now suddenly 10 cents, then the stock is less liquid. And the more liquid your stock is, means that you get filled quicker. It is a question of supply and demand. Every stock has different liquidity, and you can see that at the back on the platform of Tasty Trade. If I do this and I am going to the most liquid ETFs, then I can see that the liquid is literally like that. But you can also see how liquid it is over here. If I go to liquidity, then you can see 4 stars. Can you see that? 4 stars. That means that Apple is a very liquid stock. The less stars it's got, the less liquid the stock is. The less demand and supply there is. The higher the liquidity, the more expensive an option is. A credit spread is selling an option to create credit and hedge to prevent risk by buying another option to cover. We protect ourselves by buying another options to have a small margin needed when we trade. Now, and I will explain that right now. If I sell an option, you can see that my maximum profit is 267 and my maximum loss is 20,727. I don't have that sort of margin, and probably neither do you, but I still want to trade this, so I will create a credit, which means that if I buy, then suddenly my maximum profit is 66, well 72 now, but my maximum loss is only 178. I do have 178 euros to put in the account. My credit, as you can see, remember we receive a credit, is 72. Now this is called a defined trade. If I take the buyout, so if I do this again and I clear this, if I just sell, then that is an undefined trade because I've got a huge amount of maximum loss. But if I buy one against it, and that is what you say, you hedge, you to prevent risk, to buy another option to cover, there's where you've got your maximum loss and your maximum profit. Now what is my POP? Well, my POP is 64%. Well, that's the difference. So my probability of profit is 64%. Now if I go up a bit, then suddenly my profit is POP is 71. But as you can see, my credit has gone down, but my loss, my maximum loss, is still 198. Now I always try to get, my maximum profit is 53 and my maximum loss is 197. I find that the risk is too big for that little bit of profit. So if I put it a little bit like that, then suddenly it's better. It's nearly half-half. Not quite, but I'm quite happy with that. And I've got a profit of 64%, chance of a profit of 64%. My delta is 789 and my theta is 773. Now at the moment that is not something you've got to worry about. But what I will say to you is that if you look at your delta here, I always look at a delta around 37. So I explain delta later, but just accept that a delta of 37 is good. Now this is called a credit spread. I'll take them away in the put. Now I'm going to do a credit spread at the call. I am selling the 217 and I'm buying the 220. My maximum profit is 85 and my maximum loss is 165. My POP is 68% and my credit is 80, which means that I get 83 cents, so you get 83 times 100. Now if I do two contracts, then it will be double. My delta here is again 36 and 26. I like that sort of delta. There's a lot else we can discuss. Here you can also see your order. You sold minus one contract. You bought one contract. You sold it for 217.50 and you bought it for 220. So this is a credit spread. You see, you get credit 83. But that is only one strategy. But I do also another strategy, which was called an iron condor. So let me go back that I sell that one and buy that one, and suddenly my maximum profit is 156 and my maximum loss is 94. But I suddenly have got four. I've got two puts, two credits, and this is called a credit spread. You put a credit spread on at the put side and a credit spread on the call side. There are different things you can do, but for the moment just understand that an iron condor is that you put a credit spread, a vertical spread as it is also called, at the put side and a vertical spread at the call side. I can see that you think, well, the $50 or the $60, that isn't much. But this is one trade. And what I always say, trade small but trade often. There's not a rule on how many trades you can do. But if you invest 2,500, every single trade should not mean more than $200 margin, which you actually have got here. You've got a profit of 150 and your margin is 100, which is well done. And if you do this, then all you can lose at the most is 100. The reason we do the credit spread is because we receive the credit. And we do only defined trades. So if I take this one out, let me do this again. If I sell this one, then my margin is huge. And if I buy that one, then my margin is really doable. So it is under the $200 margin. So that is the two strategies we use. Do you have any other strategies? Yes, you have a lot of other strategies. And to show you that, I only have to open this. And there you can see a vertical, a strangle, a straddle, an iron condor, a covered call, a butterfly, a jade lizard, a calendar, and you can even buy a stock. But that's a lot to take in, and that is why we only do a vertical and an iron condor. And that are the only strategies we discuss in this book. But, as I said, this is a defined trade. Now let's go back to our PowerPoint, which is here. This is a defined trade. You know your profit and you know your loss. You know that at the call side and you know that at the seller side, the short side. An undefined trade, where I showed you that you had suddenly a margin necessary of 20,000, that is an undefined trade. Now at the long side, that means that the buyer has got an infinite profit and a known loss. And at the seller, and we are sellers, you've got a known profit but an infinite loss. Now you might think that the buyer side is much more profitable, and I can understand why you think that, but consider this: if you buy something, you've got to know where the market is going. And as I explained at the beginning, the buyer needs to know if the market needs the market to go up. As a seller, you've got 4 other options to make a profit. The market can go up a bit, it can go up a lot, it can stay the same, can go down a little, and you only lose when it goes down a lot. So statistically, the seller makes more profit than the buyer. And there is another point which you have got to consider, is that between the buyer and the seller, you have a zero sum, which means no money is ever lost. It just goes from the buyer to the seller and vice versa. So if 75% to 85% of the options buyers are losing money, then we as sellers should win 75 to 85% of the time. We collect the money from the buyers, the premium, and just wait until expiration comes around and we can keep the premium. For the buyers to win, they have to be right in choosing the direction. And that is not so easy to always choose the right way. Where is the market going? Well, I don't know, and neither do you. I hope this helped, and I'll see you again with the next video. And we are going to talk about defined and undefined trades, which I basically already touched on.